Welcome to Money Hangout once again. Every week we talk about something which is top of your mind or some suggestion or advice and try and take as many of your mutual fund questions. This is brought to you by Birla Sun Life and Value Research. Today we are going to talk about something which one of our regular readers, regular visitors of our website, Rajan Agrawal, summarized it so nicely that I thought of sharing these ideas with you in little more in greater detail, simply because we keep talking about all the things that you should be doing, but he very nicely summarized all the things that we should not do. So these are, today we are going to talk about 5 crucial money mistakes, investment mistakes that everybody should of your financial life, which is very common and which is worth avoiding, and explaining them. Why you should do that. They are also sometimes the mistakes are the general beliefs. Everybody thinks that that is something which is very normal to do. Most people do it, and why it should not be done. What is wrong with it? We all know about the big mistake. Thinking of the blunders or the mistake which we can only say with hindsight of 20 years, 30 years, 40 years. I'm just reminded of the third partner of Apple. We all know about the two Steves, Steve Jobs and Steve Wozniak. They created or built a great company. They created great products, a great company, and they're a beneficiary of that. They became wealthy. There was a third partner, Ron Wen, and he was not a believer or whatever it be. He sold off his stake in 1976. And he sold it for a sum total of $850. If he would have held all this till now, that will be worth $35 billion, an eye-popping $35 billion. That would have been the worth of the stake of the third partner of Apple. So now we get it that there are mistakes which after a decade or two we can realize, but that is only the hindsight. I'm just going to talk about some of the things which all of you should take note of, should not be done, and the rationale for it. It's not easy not to do them because they are sometimes the general beliefs. The first one is that our deep belief in the safest investment, which is investing in fixed income, investing in low yielding long-term fixed income investment. And there is a reason, this is something which happens all the time. Most investors, their money get invested in EPF, which is mandatory. Then everybody tells you that make that FD, make that, do that fixed deposit, or open your PPF account. These are long-term, low-yielding, fixed income returns. They are not going to make you wealthy. But a deep-rooted belief that, these are the way to go. And there is a reason for that. There is a reason why we believe this way, why we believe in them, and why earlier generation generation of people used to believe in them. First and foremost, we did not, market was not accessible to them. Today, the way you can buy mutual funds, the way you can open an NPS account and half of your money gets invested in equity, it was not possible 20 years ago, 25 years ago. The only way to invest, save your money and grow it was PPF or fixed deposits. So that was the only. So accessibility was one thing. The other thing is that that is how we are configured. That is how we actually get initiated to investments. Our parents tell us that open your PPF account, do your FD, and we do it. That is fine. It protects the capital, grows your money nominally. But it is not good enough to beat inflation. The primary reason why we do it is that this is how the whole country was configured. Government, we were used to this PPF designed as a long-term saving, discretionary retirement savings plan, yields fixed income. The employee provident fund yields fixed income. So somebody who is 20-year-old, 22-year-old gets into the workforce, gets into the organized workforce. And he starts, the money is deducted. The longest term investment, savings that he's doing gets deducted from his salary and gets invested. in something which gets you fixed income, because that the most of the money is dominantly invested in bonds. And of course it's structured differently, but the investors get an experience. Of course, people get impressed with the compounding at lower rate, or also over a period of time, leaves an impact on your mind that okay, your money is growing well, nicely. But that is not true. Think of what has happened to your EPF account or PPF account with 8.5%. Assuming this was growing at 16%, what will be the net effect of all that effort? Money compounding at a faster rate, and more so for your long-term money. I think this is one mistake which most investors should take note of. You should not have fixed income investment beyond the essential emergency fund in your initial stages of life, because long-term investment in something which is inflation linked, grows over time, that requires time, and that is the stage of your life when your money should be dominantly invested in equity beyond the essential money which you can lay your hands on anytime. Another common mistake which most investors should be very clear of, and it is very difficult to do that, which is combining insurance and investment. We all get started with some insurance plan, and that typically is a very small component of your money is buying insurance, and a good part of your money actually gets invested, and you get the worst of both. Splitting these two things, and why you are being curious, asking the very basic question that do you need insurance, and if you need insurance, how much insurance do you need, and which is the best way of getting that protection. And that will vary for person to person. The moment you have the time when you have no dependents, no financial dependence, you don't need insurance. And the moment you have any financial dependent, you need a large insurance, and that is achieved with a term insurance. So be focused on the utility of all this, and when it comes to investment, evaluate the appropriate investment, make regular investments. And the other criteria which actually should be looked at is your money portable? Can you take your money out, or can you move your money if your investment is not performing well? That is something which is not possible when you mix insurance and investment, and you end up buying the worst of both. So this is a important mistake, and which every investor should avoid. And the other, why it is very hard to avoid this, because you come across a friendly neighborhood insurance agent who tells you the benefits without explaining you the alternatives, and it becomes very hard to escape that. And most people get carried by these investments, insurance linked investments, primarily because nobody evaluates them objectively. So ask the very basic question: the risk, return, and the liquidity, and the tax efficiency or the tax benefit that you will get. That is one part of it. And if you are buying insurance, what is the protection that you get, and do you really need it? Is it good enough? Is it the best way to achieve that? Then the what I was talking about, the Steve Wozniak and Steve Jobs and Ron, which is getting carried by the downturn, getting the long term, losing a long term focus when you hear the short term noise. You remember 5 years back, everybody was saying that our country is going nowhere. The economy was in a downturn. It looked like a hopelessness, and from there our market is up despite the absence of economic growth. Our markets are up nearly 55% from those levels, which in itself was at a decent level. So I would say that most investors lose perspective when you are bogged by bad news and noise in the marketplace. And market is a very noisy place. On a day-to-day basis, it could be very noisy. There's a famous quote which I really like, which Bill Gates said that in his book, that most people overestimate what you can do in 1 year, and grossly underestimate what they can do in 10 years. So most people overestimate what they can do in 1 year. Is a classic problem which causes anxiety, because we expect that after we have made the investment, my investment must do well. and we lose sight of what these investments will produce over the next 10 years, and we act irrationally, we act in haste, and many a times we panic. And I have done it many years ago, getting out of at the wrong time, and trying to time it and losing perspective that what I am investing for, what is my time frame. So not losing sight of what you can do, what this money will do for you in the 10 years, and that's an important thing. Avoiding the noise in the short run, and booking profits on good investments to put into underperformer. We all think irrationally when it comes to investments. We think that something which has done well, we must realize the gains, otherwise these gains will sometime vaporize or they will disappear. And we bet on our losers, we bet on the underperformers, because we think we psychologically are unable to reconcile that some of the investment decisions that we made is not working. That's a wrong thing to do. Having a methodical approach to riding your winners, weeding out your losers, and rebalancing is the way to go about it. Rebalancing across investments, across asset classes, is the only way to approach it methodically. It's an important thing to do, but there must be a method to it, and rebalancing actually helps you do that. And I think one of the biggest thing which will actually translate into great disappointment for many people is lack of discipline of dipping into your retirement savings. Today the avenues of spending have just opened up. Today we have a lot of things on which we can spend money, and because retirement is many years away, we don't take it seriously, and we lose the sight of that, and we miss out on the whole compounding magic of compounding. So, and the efficiency with which, the ease with which we can take our money out is only adding to it. Most of our investments are liquid, they're transparent, they're accessible. So if you are not disciplined enough, if you are unable to resist your temptation to take your money out on the smallest of need, you are in for great disappointment. Retirement is going to be a very difficult for two reasons. One is the inflation. The other is most people will have to provide for their own retirement, because we are not working for the government. We are not, even the government employees are no longer going to get inflation adjusted pension at the cost of the taxpayers. So most people have to provide for their retirement themselves, and then we are going to live longer. These are two things which you should keep in mind. If the longevity has gone up from 70 years to 90 years for working class Indians living in cities over the last 10-15 years, this is a wake-up call. If you retired at 60 and passed away at 75, you have to really provide for 15 years. Now if you are going to live till 90, you have to really provide for 30 years. That is a big problem. That is a wake-up call. You have to really worry about it, and you have to really over provide for your retirement than working on the borderline that you are barely providing for it, and this could turn out to be a disaster. So 5 things which I would like to summarize. Don't bank on low yield fixed income investment for the long term. Never combine insurance with investment. Don't let short-term noise distract you from your long-term approach to investing and your long-term goals. Booking profit from your winners and betting on your losers is a bad idea. And create a retirement-oriented savings plan, and never dip into that. Keep it as a sacrosanct area of your investment which you will never take out, because that is going to be a very challenging goal as the kind of age we are getting into.
Thank you, Dhiren.
Thank you.
We now move to the questions for today's session. First up, Abhishek says that he does not wish to prepay his housing loan, which has an effective interest rate of just 5.8% post-tax. He wants to instead invest this money in a relatively safe vehicle. So he wants to know what could be these safe alternatives to a savings account for this purpose.
One is that I agree with his approach that this is a long-term borrowing, and the cost of that is lower, even if he's not taking his effective rate, assuming it is 8.5 or 9%, on a 10-year or a 15-year period, his equity return will produce more return. His equity investments will produce more return. So this is the only kind of borrowing which is justified. So he should carry on. He's thinking right. The way to approach it is, it entirely depends on the time frame on which he needs the investment. This money, how long is he going to invest for? If it is not needed for next 15, 20 years, then I would think that he should not be as conservative. He should be conservative, but he should consider a balanced fund. The way to average, the way to reduce his risk is he should buy a moderate, conservative vehicle, pick a balanced fund, and spread this investment as it will be a large sum of money. Spread this investment over a 18 to 36 months time period. Averaging his investment will reduce the possibility of catching a market high, will not cause anxiety, and it might also translate into some opportunity losses, but that is fine. Reducing the risk of catching a market high is more important for any investor who is thinking so, in a measured way. If he is likely to need this money into 3 years time, 4 years time, then he should consider a short-term debt fund, or maybe 5 to 7 years time frame, maybe some of the MIPs within the growth options, or they will produce more return than the fixed income funds, or an all debt fund, and holding for 3 years and more will also make it a little tax efficient. So it entirely depends when he is likely to need the money.
This next one is from Gagan. He says that he booked profits in February 2017 and has not re-entered the market for fear of catching a high, as you just referenced, Dhiren. He holds a lot of money in liquid funds, and he asks if he should transfer it to short-term or dynamic bond funds. He has a time horizon of 5 years.
This is a very unfortunate situation. February to now, one has missed a lot of opportunity. In fact, this is something which many investors do a mistake. When you take your money out from equity for sake of a change, moving your money from one fund to another, and the money, once it lands in your bank account, then you think that you would rather time it a little bit, as it turns out to be a sizable money. This is a bad idea. When you are moving your money from equity and this money is a long-term money, then there is absolutely no harm in moving that money into another equity fund for sake of investing into a superior fund. You should not wait for, you should not try and time it. You should be, because as we know that some of the big gains in equity comes in a very surprising way on surprising occasion. In fact, the next issue of our magazine, the Mutual Fund Insight, we are doing a story that what is the worth of your money if you miss out on some of the big 10 days in which the market gained, and investors lose enormously. This is an opportunity loss. So moving your money from a short-term bond fund to dynamic bond fund will actually enhance your return by maybe 1.5% by assuming certain risk. But what you have missed on by being out of market from February to now will be about 15 to 20% gain, depending on the kind of fund that you took your money out from. So I would suggest that if it is a long-term money, invest methodically. Average your investment as you have missed it, because catching a market high now, if the market corrects, will be even more disappointing. So stick to some plan. When moving your money from equity and it is likely to be a long-term money, move the money to equity fund in a lump sum way. No problem with that. If at all you are trying to time it, then put the money to a methodical plan. Do a STP into an equity fund over a 6 months period, 12 months period, 18 months period, to your convenience. But do it. Put it to a plan. If you worry about the level of the market and put money in a liquid fund, you have seen the missed opportunity. The return that will be generated in liquid funds in a reasonably predictable way over the next 3 years is what you have missed out in the last 4 months. So make a plan, stick to it, don't try to time it.
This next question relates to the hottest topic in the country today, Dhiren. Atul asks whether he should invest in any particular sectors post GST.
Yes, you should invest in a business which will be a big beneficiary of GST, but don't try and do that, because that is why you hire a fund manager for. My sense is that in the short run, most businesses will suffer because of the realignment or the change or the confusion, or a lot of people who will be aligning with it. And GST means different things to different people. Small businesses will suffer. Some businesses will find it difficult. Some businesses will find it cumbersome. Some businesses will find it easy. Some businesses will find it very convenient that they can now produce their stuff anywhere, sell it anywhere with the least of friction. So businesses in the long term will benefit. Large businesses will benefit more. Consumer businesses will actually benefit substantially. But most businesses will benefit in a reasonable way. This is a predictable, fair, transparent system, but we have to see it comes with how much of glitch, how much of a problem that we face in implementation and execution of this. And I'm generally apprehensive of anything of such a large scale being done by the government. Of course, the government is showing symptoms of being a little more efficient than in the past, but it is such a large machinery to be built and has to work that it is bound to come with some issues which will cause dissonance. But don't try and do that. You are entrusting your money to a fund manager who will take care of it. If at all you want to do it, consider some of the funds. There are some thematic funds which are trying to capitalize on the consumer as a theme. You will have the Birla Sun Life Buy India Fund or the Lifestyle Fund or something. But I think many businesses will actually benefit, and I generally urge you not to do that. Don't consider a thematic or a sector fund. Choose a fund, a good fund, and the fund manager will take care of it.
Next up, Vijay asks, how can he know that an investment will turn out to be a multi-bagger or become utterly worthless? He says no one knew in 1976 that Apple would one day become the world's most valuable company.
It is very difficult to do that. In fact, it is easier to ensure that your investment doesn't become worthless. And in fact, investing in mutual fund is a way of doing it. You are diversifying and you are investing regularly. That itself takes care of it, that your investment will not become worthless. Finding that multi-bagger, it is nearly impossible to do it, and you don't get to know till it has already happened. I would say that if you can actually develop some interest, be curious about businesses, there will be businesses which will actually turn. Apple is a very old story. In recent past, we have seen in the United States some businesses which did not exist 10 years back, 15 years back. In fact, Apple's story itself is a rags to riches story. Apple came, it prospered, it became very valuable, then it went down the tube, it actually faltered, it became worthless, and then the whole iPod scenario emerged. Steve Jobs came back, and then what has happened to Apple in the last 8 years, in last 10 years, since the launch of the iPhone, and the way the company has been configured, it's very hard to really guess in fact, it's so uncertain that I really wonder that Steve Jobs would have been able to guess that what will be the worth of what will be the worth of Apple. Will it be so successful commercially? I think if Steve Jobs would have been aware that he is actually on to build a great company which will create a great product, but the commercial implication of that will be that it will become one of the most valuable companies. Apple iPhone will be the only phone which will have the highest margin, and it will be a rage worldwide. Nobody knew that, and I don't think one can know that. It's very hard to guess that. Maybe keep your eyes and ears open. Consider investing in stocks. But I think the next best thing, if you can't do that, is choose a good fund, invest regularly, and increase your investments as your income rises. That will not create an opportunity as buying the Apple stock will do, but the alternative can also be very satisfying and reasonably satisfying and will actually match your temperament too.
Dhiren, you've talked about the opportunity cost of investing in debt for long term. This next question is in that context.
Sure.
Mr. Ghosal asks if staying invested in a debt fund for more than 5 years is a mistake.
There are reasons, there are investors who are extremely averse to any risk in the interim. There are also some situations that you are planning to buy something, but it is contingent on something, but it did not happen. Maybe you changed your mind. So it could be a need-based thing. The third reason why you should have fixed income is that I think 5-year holding of a fixed income investment may not be a mistake. Excuse me. If it is part of your pre-decided asset allocation, if you have decided that 25% of your money should be in fixed income, and that money should remain forever, and you are periodically doing a rebalancing, so in these situations it makes sense. But if it is just a long-term investment and 5 years just for the heck of it, because you have been waiting to move money into equity market, that is wrong. That is a mistake. If you are a long-term investor, you should not be into fixed income. And I would think that 5 years and more can well be defined as long-term. Yes, for a 5-year period, consider a more conservative option to invest in equity.
Next up, Mr. Nair says that while investing is important, isn't it more important to manage risks in life through insurance and fixed income?
Yes, absolutely. In fact, your first insurance is having the emergency fund, and that money should be, a part of it should be lying in your locker. Then the money should be lying in your bank account. And if you think that some of the emergency that you can contemplate, that you can visualize will need more money, then that money should be lying in your liquid fund. So these are this is your first level of insurance: money lying in your locker, bank account, and liquid fund or deposits. Then comes, if you have a large enough potential liability or need to buy protection for your family, you must have life insurance. In fact, life insurance in the priority of things should come ahead of investments. And after that, if you have financial dependence, you must have life insurance. But you don't need that protection once you have dependents and you have been able to build your investments to a scale that it will be taken care of. You need insurance when you have the need for financial dependence, and if you are not around, that needs to be fulfilled. So you are absolutely right. People need emergency fund. People need fixed income for that need. Then you need protection, and for that, the best vehicle is to get the term insurance. For a small sum of money at a young age, you get a very large insurance protection. And then also, in your overall scheme of things, for your overall portfolio, to reduce the risk of an all equity portfolio, you combine it an amount of fixed income to reduce the volatility of your portfolio in general. So these are the needs which fixed income and insurance fulfills. But as at the outset, the key mistakes of your financial life which you must avoid: don't mix insurance and investment. That is important. Don't make long-term investment in fixed income.
Moving on, Abhijit asks if it is always a negative sign when a fund stops accepting fresh investments and only allows existing SIPs to continue.
It definitely is a reflection that the fund manager is not comfortable accepting that money, accepting large amount of money in the fund. It could be a function of a strategy. A small cap fund or a micro cap fund, it is very hard for it to actually turn big and continue its good work, or finding opportunity. It could be also a function of the level of the market. If market generally has gone up and he's finding less opportunity, it will be hard for him to accept the money. So yes, it is a reflection of the market being pricey.
Next up, Mr. Mehta asks why equity mutual funds redemptions take 5 days to be credited. He asks where do the proceeds sit while they are in the redemption process.
Generally, it doesn't take 5 days. Mostly it takes 3 or 4 days, depending on the way he's getting the remittances. But T plus 2 is the method devised because the underlying investment has to be sold and it takes 2 days to realize it. In fact, when you investment up to 2 lakh rupee gets deployed that very day itself. So deploying money and getting that NAV is immediate, but realizing money, because even when you sell stock, you get your money after 2 days, and then the broker sends you the money. So I would imagine that generally speaking, I think T plus 3 transaction day plus 3 days, you get that day's NAV. The transaction is done on that day's value, but you get the money, and this money is not deployed somewhere. The fund manager makes the redemption request, gets the money, and then you get it. And so this money, and I think the way fund accounting and settlement works is that the fund remains invested in the fund. Just that there are investors who are making investment and there are investors who are actually making redemptions. That thing first gets squared off before computation of the NAV, and then you get the remittance, and then the money is in the pipeline for about a day.
Dhiren, we'll extend the session by a few minutes to take
Sure.
a few more questions today. Next up, Priya asks, how can she protect herself from currency fluctuations for her Indian as well as international investments?
The way to buy currency protection is to hedge your currency in a certain currency by buying a derivative. But I think most investors should not do that, because in the long run, if you are making long-term investment into equity, assuming that you invest in a US market, you invest in a US fund, or you invest in the Nasdaq fund. So the rupee, the long-term trend is that the rupee depreciates over time. In the short run, rupee might appreciate, as it happened recently. 68 levels to 65, 64 and a half, 64 rupee 50 paisa for a dollar is an appreciation, but the long-term trend is that it will depreciate. And long-term depreciation of a currency is a function of the interest rate differential. If the interest rates in that economy, or where your money is invested in or denominated, that differential, if that is low and ours is higher, which means our currency is bound to depreciate over the long run, just to bring about the parity, and that is the long-term driver of this kind of thing. So you should not do that because if you are making long-term investment, things will get back to normal. In the short run, sometime it can actually cause anxiety.
This next one is from Avinash. He asks, what is a good day of the month to institute his SIP?
It doesn't matter, because it is hard to guess which day will actually work out, and there is absolutely no statistical. It is random. The core thing is that do it for a long period of time, do it methodically, do it with discipline, make sure that it happens. In fact, I would say that if I am doing a SIP once in a year for next 30 years, that is my SIP. If I am doing on a specific day of the month after month for 5 years, I don't think it will be, it requires a great deal of luck. It will entirely be luck. It will be completely random. It is hard to guess, but I think the difference, I'm very confident that the difference on any specific day will not be there will be no material difference in your investment return if it is any day of the month. And if at all there is, it will be purely coincidental. It is impossible to guess that. But I'm reasonably confident that it will bring about absolutely no meaningful difference. Even if one gets very lucky with the day of purchase of every month, if you pick the worst day of the month and start making your SIP investments that particular day, on a 5-year, 10-year basis, the material difference will be absolutely meaningless.
Mr. Vaz says that history shows that major crashes have occurred after the Sensex crossed a PE of 25. He says that the PE is currently at around 22.5. Will the history repeat itself?
I don't know, and nobody knows. The critical thing is that one should understand the dynamics of it. There are reasons, price earning ratio can go up for a variety of reasons. When earnings remain constant and stock prices go up, PE can go up. The PE can remain at this level, and if companies are able to grow their earnings, the prices will still go up, and PE can actually come down, or they can remain at the same level. Either cases, I would agree with him that if the market is at a very elevated level on the PE for a sustained period of time, any disruption in the flows in the market will cause a big decline. And if companies are going to, and if earnings go down further, these P's will look even higher. There is a possibility that stock price remains constant. Companies' prices, stock prices, despite being constant, if companies earns less, the earning goes down, the price earning ratio will look much higher. That can cause great disappointment. So if we are going to see big earnings decline, or we are going to witness some big disruption in the flows, this can cause worry, and it is very hard to guess. I think earnings should go up, should start going up at some time, as a result of all the big changes that we have seen, hopefully. But at the same time, the kind of momentum that we have seen in the flows in recent past, in recent year, that looks quite impressive. I have never seen this kind of sustained flow in the market by design. The EPFO money is flowing into the market, the NPS money is flowing into the market. Today, mutual funds have been able to build a SIP book, the money which is coming by way of SIP into equity fund, to the tune of 5,000 crore. This is besides all the money that comes from the insurance companies, the money that comes from the FIIs. So assuming everything else is erratic, the kind of steady flow that is finding its way into the market, that makes me very, that makes it very difficult for one to guess what will actually disrupt the market.
We'll take one last question for today, Dhiren.
Sure.
View Madhav asks, how often should he review his portfolio, particularly his equity investments?
I would say that, glance through it every year. Look at it as often as you want to, but look at it every year, or and look at what you want to look at. Look at your asset allocation, look at the performance of the fund, and looking at it, reviewing it is one thing, but what you are going to review and what will prompt you to act is something important. Decide it beforehand, what you are going to look for, because just looking at it and trying to act may not be a desirable exercise.
Thank you, Dhiren. Any closing remarks?
Thank you very much. Yes, we keep making suggestions about what to do, but making sure that these 5 things what should not be do, I think is more important than what you do.
Thank you, Dhiren.
Thank you.
Thank you, everyone. That concludes today's session.